Are ready and live. Welcome back to welcome back to Markets with May. Today we're going to go through the MegaCap tech companies that just reported this evening. And I mean, I don't know if they just all decide to report on the same day every quarter, but it drives me crazy because I'm going to go through Google, Apple, and Amazon. Obviously, there's Ford and Starbucks and a whole mess of others, Qualcomm, T-Mobile, that all reported as well. But I chose to do these three because of their importance to the major indices. And I'm going to share my screen and demonstrate that first. And then I'm going to go through in order Google, Apple, and Amazon. I do think that if you're just reading the news flow, and in particular, even if you're just reading the transcript or what have you, it's a little bit not straightforward because this is really the quarter where there were so many extra charges. I mean, this took some math. I'm not going to lie. There was a lot of like, wait a second, what is that? Hold on a second. And if you didn't have a chance to go through it, or if you're still kind of coming up the learning curve on how to read these things, I could see this quarter being particularly difficult to interpret and infer. Okay, let's get into it. Past performance, not indicative of future returns. I'm going to share my screen. We're first going to go through the weights and the indices so you can know where I'm coming from with this. Even if you don't care, you're going to care. Why? Because they are 26%, these three companies of NASDAQ. I use the triple Qs because even though it's got a little bit of a difference, it's more or less the same. And then it's 12% of the S&P, which means however these three decide to move, if they decide to move at all, is going to dictate how the market's going to trade tomorrow, whether you like it or not. And the real key is if you're looking at this too fast, sometimes you forget there are two share classes of Google, Class A and Class C are both included in both the indices. It's kind of this strange oddity. In case you're curious, you want whichever one has the ticker GOOGL because that one has voting rights, the other does not. Okay, now Google first. Not as bad as it looks is the way I'm going to say it because, man, when I first got the release, I was like, what is this? But one of the challenges is they have some massive private equity charges, and at fair and square, those are non-cash. So ultimately, when you go through the cash flow statement, they got to jump that back in. So it's not quite right to have given them credit last quarter, nor to give them credit this quarter. So on the adjusted numbers, it's not nearly as ugly as it seems. Still kind of on the ugly side, but you know, even though I was really kind of nasty about Meta yesterday, it was really more because the thing traded up 20%. But in fairness, Google did have a better quarter. And let's talk about why. Okay, revenue up 1%. That's about the same as what we saw with Meta. In some ways, actually, Meta was down a bit on revenue. But what makes this extraordinary is because they actually didn't do a great job hedging their FX. Now, obviously, I have to penalize you for that. But at the same time, it's a little bit more understandable. Operating income was down 15%, but now let's look at what the composite of that was. A bunch went to R&D, 17% up. Costs were up 9%. I'm going to show you that a little bit more, but some of that is charges that are going to not be alleviated until at least the second quarter because they, as we all know, have announced layoffs, and that's going to take additional money out of SG&A and just regular cost of revenues from labor, headcount, et cetera. And then G&A was up 23%. That's where you're going to see changes in the future. It's some of the layoff type related costs. I'm trying to be sensitive as we talk about that. And then net income, this is the line item that you kind of have to adjust for. So you have to subtract that from that and add that back into that so you get some sort of normalized situation. You have net income still down 35%, but once you do the math on that, it's not nearly as bad. Can't believe I didn't do the calculation. So other income, this one right here, that is private equity investments. And again, it is non-cash. Okay. So it's just a mark to market sort of thing. The other things that I kind of want to highlight on Google, this is part of the reason why I'm like, interesting, not as mad at you as I would normally be otherwise. Okay. So if you look at it, Google services is really the part that had the problem. And they do a further breakout of this, which I will go through. Google services is basically everything, including YouTube. So then you're like, okay, what's going on? Is YouTube having problems? Here is the breakout of what's going on there. You do have Google search and other down quite a bit, or down a touch really, but and YouTube down a touch. That is just flat off of ad spend issues. And interestingly enough, I had mentioned this in the other calls, that I didn't think ad revenue was going to be great, and that I think that some people don't realize what a big component the crypto guys were in past quarters of ad spend, particularly for the finance companies. It's something that probably is less obvious unless you're a YouTuber, basically. So I get paid more for your screen time. Thank you guys for watching this as far as that goes, because it just turns out that financial companies pay more than other advertisers per view. Okay. So having that out actually does make a fairly notable difference. In some cases, the finance companies pay like 5x what might be paid for some other types of views. So that's what's going on there. It's just a strange oddity, but that came out of both YouTube and search. But what was interesting is that they actually had more traffic, and they had actually quite good results if we were to do some sort of user count metric. And part of the challenge is because, unlike Netflix and other media companies, they don't give you subscriber numbers, because it's just not the way that YouTube is structured. Like YouTube, if it would just do its earnings the same way that Netflix would do it, you would totally feel differently about the quarter as far as that goes, because they had an increase in subscribers. They had the shorts business be stickier. They had more content created. They had more ways that people were using YouTube to make money, meaning that it's not just one way that people have, but all of the different ways that people can make money from using YouTube for long form content, live casts like me, shorts like others, or podcasts. There's like a bunch of different ways that I have not yet to. All of those on an actual usage basis were up, as were just viewing time. It's just that the ad spend overall was a little rough. So unlike someone else, Meta, they're not having an issue as relates to business model impairment. Now, in fairness, I think Facebook actually showed slightly higher viewing, so to speak, and it kind of depends on how you slice the numbers on time spent versus number of people and usage, et cetera. But it's a little bit less ambiguous what's going on at Google, which is just sheer raw ad spend decline throughout the entire space. Okay, other things. They are going to probably do a number of oddities as relates to costs across all of this. This is what the goal is on the strategy to bring G&A down. And it really is the headcount reduction. Plus, they're going to switch up office spaces, and they're going to incur a bunch of charges to finish off those leases. And then you should see traffic acquisition costs go down dramatically in 2 quarters. Okay. This is like the absolute epitome difference of why I prefer Google to Facebook as relates to strategy at this particular point in history. Nonetheless, Facebook traded up crazy today. As you know, you guys all know how I feel on that from yesterday's video. Google is trading down in the pre-market here. I mean, it is what it is. Okay, the geography breakdown is this, as thus. And you can kind of see how big a problem FX was. It would have been up 7% on revenue. But unfortunately, because they failed to get FX under control, it was up 1. And you can see it was both EMEA and which is Europe, Middle East, and then APAC. All of them did it, as did Latin America. So it was just complete failure on the hedges to produce enough revenue to offset that. You can see that here. Okay, what else do we have for them? Oh yes, YouTube. So yeah, so they're the strategy very different from like a Meta. Okay, they're ramping up the shorts, same as Meta, and they're doing a great job there. They're actually able to take market share because of large screen viewing, which Facebook has, but it's not a major focus for them. So this will continue to take share from other folks, let's call it, that have subscription based stuff. Subscription revenue growth has done really well. This is not related to YouTube over here, but Pixel, the cell phone, is also doing well. And they've got a number of objectives to try to make it easier for people to sell through YouTube directly. Yeah, so they're taking share with Pixel as a phone and Android. And the other and last thing with Google to kind of talk about is AI. Most of the call was related to what they were going to do in the way of AI. As a lot of you guys probably are well aware, Chat GBT is a big thing right now, and they've got things that they have in store for the future on what's going to happen there. They believe that that will also be very useful in a number of different spots, but they plan on being the AI kings as far as that goes, and they're plowing money into it. Now, along those lines, there's one other thing I kind of want to show you, and that had to do with the cloud revenue, which I was really surprised about. If you do the walkthrough on, let me see if I included it here. Yeah, operating income. So if you look at this, cloud was up a lot. Cloud was up 32%. And you did have actually a lower loss associated with it. We're getting really close. Before this, cloud was just everybody's whipping post for what is going on at Google. But it looks like they're right about to turn the corner on that. And then yeah, that's other bets is a little bit of all that AI. So that's going to continue to have losses. But I mean, in fairness, given what Google is, that's the right call. Okay. Yeah. So then moving on to Apple, I really think this was a meh sort of quarter. Like, I don't love it. I don't hate it. I wouldn't be surprised if it trades flat tomorrow, to be honest. But it was very much a meh sort of quarter. Let's go through it really quick. Sales were sales were down 7.6%, all on the product side. At the same time, if you listen to what they had to say, you really do get the impression, with China reopening and other things happening, that that's going to be fine going forward. Additionally, they did have constraints on iPhone in particular as relates to supply that has now been alleviated. Operating income down 13%. Mostly it's the R&D increase in spend of 22%, net income down 13%. I mean, I feel like people kind of knew that something was going to happen like this with Apple, so I can't imagine people getting too crazy. Inventories were up 38%. That's always something that people get a little intense about. Personally, with China reopening, I think they're going to be fine as relates to that. Plus, they really struggled on the supply chain in a couple of different spots. Then when we go through the breakout, interesting, but like Mac down 28% with iPad up 29%. I mean, in fairness, it's, they kind of replace each other, because even if you get a higher selling price, you get more costs associated with one versus the other. So it ends up that kind of just more or less crosses each other out. And then services was really strong. Apparently it was every type of service, period. Everything from music to, actual apps download. It was like literally everything. So it was just very strong on the quarter. Interesting. Okay. And then they had a lot of discussion about the fact that the wearables business, even though it was down 8, they had more new users than ever before so I was looking at some of the chats, but I'll come back to that at the very end, guys. So please do put your questions in the chat if you got them. So they talked about the fact that the wearables and some of the new value added that's going on there is a big deal. And that is going to be, with all the security features and health features that are offered, they could see that growing in a more normalized environment. So it was a really decent. This quarter was an anomaly. We're hoping the following quarters up against easier comps should do great. I actually am okay to give them that. FX was a problem for them. Margins, some people mentioned on the call that China, as it opens up, would give upside. And in fairness, traffic already was supporting that. In China, they were seeing the stores do better, and sales therefore subsequently passed through really well. So Apple, I mean, I think it was really expected given how it traded all quarter. So I would be shocked if this thing does too much. Um, let's see what else we have here. Okay. I'm going to share my screen again, and we're on to Amazon. Now, Amazon was not great, okay, but it could have been a lot worse. So I had mixed feelings. At first, when I looked at it, I was like, this is horrendous. I don't even know what to say. But then when you go through it and you realize that you've got some weirdness from last year, which they got credit for, and it drove me insane. But now they're getting the opposite of credit for it. Amazon, not as bad as it looks. Okay, sales up 8%. All the revenues are coming from service sales. In other words, yeah, it's all coming from here, right? That's up the most. Product sales are down. Again, the retail business is a problem, but we are seeing some things which I'll comment on there. I think it's interesting. I don't think it necessarily means they're going to turn around that retail business, but there may be some other things happening. COGS up 3%, fulfillment up 3%. That always bothers me because, quite frankly, your cost of goods sold and your fulfillment, there is some cost of goods sold that absolutely is that service sales business. But we all know that the fulfillment, which is the shipping of stuff, that's Amazon proper, the product sales. And, you know, if you can't get your revenue up, it's weird that your fulfillment keeps going up. Tech and content up 36% made me go, as far as that goes. And then sales and marketing up 18%. I didn't think was ideal given where the layout of stuff was as relates to where they actually made money. So I didn't love that portion. And as a result, you've got operating income that's down 20%, right? To 2737 to 3460. That's not great. Sales up 8.7, operating income down 20%. That's bad. The only reason I'll say that it was not as bad as it looks is because when you look at EPS, if you just use that number, it looks like they were down 97% or something crazy. But this is because of the private equity stuff. Last year, I lost it on Amazon. You can look at my old videos because this 11 billion, everybody was like, oh my God, Amazon's so awesome. That was Rivian, right? And in fact, if you would have compared their operating income to the previous quarter, you would have seen nothing but nastiness, kind of like what you're seeing this quarter, but at least there's no cheating this quarter. So I'm a little bit nicer about it. Still, nonetheless, if you add back in all of the private equity charges, and then subtract, add, subtract, get rid of it, then you end up with an adjusted down 20. So it's not like there's extra stuff going on. Operating income down 20, EPS down 20 on an adjusted basis. Why they didn't just do that math for me, I have no idea, but that is what it is. Okay, that's not great, for lack of a better way to say it. The only reason that it could be better than not great is this adjusted number. And that's because if you thought, oh my gosh, 97, and you're bracing for that in the AM and realize it's only down 20, you might not be as reactive. Who knows? Here's the business divisions. Bad, the US, that is bad. You have higher revenue, you have lower earnings. That's not how we like to roll, okay? International is horrendous. I mean, they talk about it on the call like it's ever going to correct itself. This has been negative since COVID started. And even I think before COVID, they never really had this business under control. But my goodness, boy, does it just bleed capital. And people are like, hey, so like, are we going to stick with this business or what's up? Right. And they're like, so sure they're going to stick with it. But we've got lower revenue and a bigger loss. I mean, so painful, right? And then AWS, quite frankly, this is also bad. All right. I know some people want to be like, AWS, so awesome. No, you can't just go by sales. Okay. You have to actually bring it to the bottom line. And you especially have to do that if these two other areas are just pulling capital from you. Because look at this. This is almost pulling 50% of the operating income out of AWS. How are you going to compete? I mean, you still got to grow the business, for goodness sakes. So that ain't great. All right. Other things I just want to show you. This was the one thing that I thought was intriguing relative to last year. I used to quote a certain number for what the online store, the actual retail business is. As you can see, it's now performed so poorly that it's less than 50% of revenues. That doesn't mean it's less than 50% of cost, by the way. We can clearly see that all it does is drag money out of AWS. So that is that. So as much as people want to be like, oh, the businesses separated would be worth more than together. Yeah, good luck with that. Because first of all, I don't know anyone that's going to be able to buy Amazon retail by itself. And second of all, Yeah, it's a big L. So that is what it is. All right. So, you did have, though, a lot of glimmers of positivity. They continue to do a really great job, uh, charging people to sell stuff on their platform, which is what ad services is. Subscription services continue to do well. That's just straight pass through, and that's great. And AWS as well is growing despite all my commentary, but it's just not as profitable as it was. There's some costs. Now, in fairness, some of those costs are coming out. I would be remiss to be so nice to Google, but not to Amazon. It's about a $600 million charge that we'll see in the first quarter for discontinued employees. And that sucks because a discontinued employee at Google, very different from a discontinued employee at Amazon as far as what they were paid originally, income brackets, et cetera. So fair and square, that sucks. And that is the recap. Final things I'm going to say on that is I actually went into the corner. Past performance not indicative of future returns, by the way. As you can see, I'm not making any recommendations on this because, quite frankly, we've had a bunch of days of very aggressive rally. We had the Fed, which everybody is still absorbing. And it sounds like a lot of people are just like, oh, the bad times are over. Let's just go into the good times. And so it's really hard to know how precisely this will trade in any way, shape, or form. Okay. So I would definitely wait until the AM for the technicians to give you a sense for what they're seeing in the pre market. Europe will probably do a bunch of stuff to give you a heads up, but it's a little bit shaky first thing in the morning. The one thing I would say that you guys should watch out for if you're more knowledgeable, but if you're not knowledgeable, do not do this strategy because it goes straight to zero when you're wrong. And that is diagonals and calendar spreads were interesting, no matter how you felt, because quite frankly, you had so much volatility this week versus next week or the following week, and that was across all of tech. So even the Qs, whether it was, I see some of you just do it, is using this one, the short tech index. You can also just buy puts on the QQQ. But what you see is the vol for this week is about 50 something, depending on choose your favorite option, and the vol next week is closer to its historical range of like 30 is what you'd expect, 36 during earnings season. So as a result of how expensive this week was to buy puts and how much cheaper, relatively speaking, next week is, you could have actually done a calendar or a diagonal to buy cheap protection. This is why I posted early this morning. If you guys are going to do specifically hedging and it is not your bugbear, let's be very honest about what you're good and not good at. Or if you just don't have options, then yeah, just use these kinds of instruments, the ETFs. But if you do have access to options and you don't feel comfortable, that is what your broker is supposed to be there for. You should contact a local person, because literally at every hour on each and every different day, it's an options trade and strategy will look very different. I just posted on YouTube like a whole list of different ways that you might consider hedging out depending on what's happening in the market and what it is you actually believe the stock is going to do. So that is a little bit crazy. Okay, let's see what some people have here. Oh, not very good at doing this. I got to take this off. Sorry, guys. Even when it was Amazon, I had that on. All right, let's see. Chat GPT is very scary. Yeah, it really is scary. I want to play with it a bit, but definitely there were rumors that some of the senior people that had more or less retired came out of retirement to get into Chat GPT. People that I've talked to, they all think that Chat GPT is a net positive, not a negative for Google. But the street likes to talk about it any which way. The fact is, the internet has been dying for some time, as we look at like mobile, et cetera. So it's just a slow death by a million cuts. And this is just one more. Shout out, Miss Tahiti. Love that you are supporting me. Update on it. Let me see if I can get something this weekend, RA. I have to let all of this clear and settle and figure out what may be interesting. There were so many topics going on. Yeah, Amazon. I really don't know which way this is going to trade, because people do. I mean, there is a design, there is such a strong bid in this marketplace that unless those puts or have been able to find a structure that's really cheap, I have not bothered going into names. It's just crazy. Um, let's see. I don't cover this yet, but I love it when people tell me what they care about. I usually put them somewhere and then try to get to them. So please do keep that coming, and just keep reminding me if I keep ignoring your name. It's not on purpose. It's just a really long list of to-do lists. Okay. That is all I have in the way of questions. Put it in the comments. You guys know I try to respond as quickly as I can. And good luck in these markets. It is completely bonkers. Take care. Night, guys.